Before we begin, let's walk through our webinar platform together. Each of the buttons at the bottom of your screen relate to sections in the ON24 console. The speaker view is where you will see our presenters throughout the webinar. The slide view is where you'll see the accompanying slides. Our poll questions will also appear in the slide area. Be sure to click directly on the slide to answer poll questions throughout the webinar. You can resize these widgets for a larger or smaller view. You may follow along also with a PDF version of the slides that can be found in the related content widget. The CPE criteria section details the requirements you must meet to receive full credit for CPE in this session. To obtain CPE, you must do two things. First, be on the live webinar for at least 50 minutes, and second, respond to 3 of the 4 polling questions that will appear throughout the presentation. You can track your viewing progress in the Earn CPE widget on your screen throughout the webinar. By registering for today's event, you will automatically receive an email after 24 hours with a link to download the slides and a link to view the recording. Additionally, if you meet all the criteria and qualify for CPE, a link to your CPE certificate will be in that email as well. Please remember that it does take 24 hours for that email to be automatically generated, so look for it sometime tomorrow afternoon. For CPE-related questions, please reach out to cpe@yptc.com. In the related content section, you can access any accompanying materials for this webinar. This includes a PDF copy of the slides and many times will often include related resources. Reactions from our audience throughout the webinar will float along the console screen. Use the Q&A section to ask questions directly to our speakers throughout the presentation. In the speaker bio section, you can find more about our presenters, including their contact information. If you need technical assistance, please use the help button below. Many times, technical issues can be resolved by opening the webinar in Google Chrome or refreshing your browser. Finally, the evaluation button contains our post-webinar evaluation survey. Here is where you can share your commentary and feedback on the presentation. We hope you enjoy our free webinar. Now, let's get into today's topic.
Market leader for our Phoenix market, and I have with me today as co-presenter Miranda Jajana, a manager in our Phoenix market. We're excited to be presenting this topic to you today. As we celebrate this season of thanks, we want to express our sincere appreciation to all of you who join us for our monthly webinars. Your growing participation and thoughtful feedback inspire us to keep delivering valuable content. A warm welcome to those joining for the first time. Before we get into today's session, let's quickly introduce YPTC. Your Part-Time Controller is a professional services firm that specializes in nonprofit financial management. We have more than 30 years of nonprofit expertise, and our services include accounting, reporting, data visualization, and best practices, to name just a few. We have offices around the country, now including Chicago and the Pacific Northwest. And we also serve clients remotely through our remote services team.
For this webinar, we will be utilizing poll questions. To respond to the poll question, you will need to click directly onto the screen. You can track your progress within the Earn CPE widget on your screen. Don't worry if you miss one of the poll questions. You'll need to respond to 3 of them. They're not up yet. You'll see them as we go. If you aren't able to see the poll questions when they pop up, you might need to resize your screen area or simply refresh your browser. And let us know if you have any questions in the Q&A widget. And with that, let's get started. In today's webinar, we're diving into nonprofit grants, from the types you might receive to managing the full process and ensuring your accounting meets funder requirements. This session will equip nonprofit staff with the knowledge to manage grants from application to reporting, covering grant types, the grant lifecycle, and best practices for successful grants management. Before we jump in, here's our first poll question. Who is joining us here today? You should see this pop up on your screen and pick what your role is within your organization. And Ben, what do you hope that people are going to walk away with today?
Well, this is a beginner level course on grants, so it could be a refresher for those who have been doing grants for a long time. We hope some of our tips will help you improve your grant management process. For those of you new to grants, we hope you walk away with ideas on how to effectively manage grants, all the way from pre-award to post-award.
Yeah, grants are something that a lot of us fall into within our organizations, right? So you often learn how to do these things on the job and with feedback from your auditors or funders. So hopefully everyone's going to learn something. I think we have, okay, finance staff. Hey, we're finance staff, and welcome to all of our other folks, our development, our EDs, our board members, programs. You're all going to learn something. It's going to be so fun. We promise.
All right, let's go ahead and dive in. We'll start by discussing grant types. Before we get into the weeds, let's quickly define what we mean when we call something a grant. Grants are financial support that don't require repayment, awarded by governments, foundations, or corporations for projects that align with their goals, such as research, public services, or community development. While grant types and funding sources vary, almost all grants will have these 4 characteristics in common. First, contributed income. The most important characteristic of a grant, it's usually a gift. Other than returning any unspent funds, you don't have to pay it back. Second, purpose-driven. Grants typically support specific projects. Think research, education, community programs, public health, for example. Some grants do allow unrestricted funding, but those are less common. Third characteristic is application-based. To receive funds, you'll need a formal proposal, goals, methods, budget, and impact. The process is competitive. There are often more applicants than dollars available. In a bit, we'll share typical items you should include in your proposal. And the last characteristic is funder aligned. Your project must match the grantor's mission. Whether it's a government agency, foundation, or corporation, read the eligibility requirements carefully. And here's a tip. Avoid grants that require you to create an entirely new program just to qualify. That's a sign it's not a good fit. As we just discussed, when we talk about grants, we're typically talking about contributions. Sometimes, though, nonprofits receive awards that are not contributions, but rather exchange transactions, aka contracts with customers, according to ASC. This distinction matters because it affects compliance, reporting, and how you manage the funds. More to come on these later.
So Ben, how can you tell whether your award is really a contribution?
Well, let's break down some of the key differences. Contributions are gifts, whereas exchanges are transactional. You're being paid to deliver something specific. Second, grants that are contributions usually support a specific project or align with your organization's mission, not just any activity. In an exchange or contract agreement, it spells out what you must produce or perform. Another sign it's a contribution is you typically apply for a grant that are considered contributions through a formal proposal outlining your goals, methods, and intended impact. Exchanges involve detailed negotiations on scope, timelines, and penalties for non-performance. Next, the funder is a partner in your mission, not a client buying services. In an exchange transaction, it's a business arrangement, not a philanthropic gift. In a contribution grant, the reporting is about sharing your outcomes and the difference you made. In an exchange, any reporting is about whether you met the agreed deliverables and not on your broader impact. For contributions, if you fail to meet reporting requirements or misuse funds, you may have to return unspent or misused grant money. In an exchange, the contracts or exchanges are legally binding, and failure to deliver agreed services could lead to a breach of contract. As a further note, oftentimes grants from foundations and corporations have a contract associated with the award. But just because you have a legally binding contract does not mean it's not a contribution. In today's webinar, our focus will be on grants that are contributions. Grants can vary by source, purpose, payment, and even donor-imposed stipulations. So let's discuss those typical grant types. First is source. Where does it come from? Government grants can come from federal, state, or local agencies. Foundations and corporations often fund projects aligned with their mission or social responsibility goals.
What about when you get a grant from a donor advised fund, a DAF? What type of grant is that?
Great question. So a grant from a donor advised fund or DAF is generally considered a foundation grant because DAFs are typically managed by sponsoring organizations such as community foundations, financial institutions, or charitable foundations. Second is purpose. What is the grant for? Program grants fund ongoing activities or services. Capital grants support big ticket items like building renovations or equipment purchases. We've also seen clients receive grant funding for general operating support. Next, we have payment. What do you get paid for? Cost reimbursable grants pay you back for actual expenses, while fixed price or lump sum grants provide a set amount regardless of actual costs. The set amount is sometimes paid in advance prior to incurring costs. Lastly, there are donor-imposed stipulations. Donor-imposed conditions are specific requirements set by a donor that must be met for an organization to keep or use the donated funds.
So what's an example of a conditional grant?
Great question. And a common example would be a challenge grant. This would be when a donor gives you, say, $50,000, but requires you to raise matching funds before you can keep it. The donor has created a barrier, the matching funds, that you must overcome before you are entitled to keep the money.
But I thought you said that grants don't have to be paid back. So why would you have to return grant funds if donor-imposed conditions aren't met?
Another great question. So remember, a grant is still an agreement. If the donor makes the gift contingent on meeting certain stipulations, like raising matching funds or completing a milestone, those conditions must be met before you can keep the money. That's why nonprofit leaders should carefully review any donor-imposed stipulations before accepting a grant award.
Okay, got it. Those are conditions. So how are donor-imposed restrictions different than conditions?
So restrictions impose limitations on how funds can be used, not on whether the funds will be received. So typically you will see donors restrict fund use for a specific program or service, or after a specified date. Obviously, unrestricted grants give you more flexibility to allocate funds where needed.
Can you give us an example of a donor-restricted contribution?
Yes, but let me start with a little background. So let's say that your organization has 3 programs, a STEM program, an after-school program, and a summer program. You receive a grant for the STEM program. This grant must be spent in the STEM program and cannot be used for any other programs or activities at your organization. And while we're on the subject of donor-imposed conditions and restrictions, let's take a few minutes to break down how they impact grant revenue recognition.
Sounds fun.
Restrictions and conditions both affect how we manage grants, but only donor conditions will impact when we recognize grant revenue. Donor-imposed conditions. For a grant agreement to be considered conditional, the grantee must meet certain requirements before they can keep or receive the funds. Generally, these are measurable, performance-related barriers, like reaching a specified level of service or producing a specific output. Like I mentioned earlier, a matching contribution, like a challenge grant, is a typical barrier we often see. The agreement doesn't have to use legal phrases like right of return, but it should clearly explain what needs to happen for the grantee to keep the grant funds.
So I see an example here that a donor condition would include a cost reimbursement grant where you'd need to incur qualifying expenses. When you have that type of grant, when would you record revenue for a cost reimbursement grant?
So the revenue would be recorded when you actually spend the money on qualified expenses. Now let's look at donor-imposed restrictions. Restrictions impose limitations on how funds can be used. Some donors will impose restrictions that are temporary in nature. For example, a grant to be used after a specified date for a particular program or to acquire buildings or equipment. Other donors impose restrictions that may be perpetual in nature. For example, contributions to an endowment that must be maintained in perpetuity.
So what if a grantor awards us an unrestricted grant for $500,000 and they say it's going to be payable over 3 years? Would you recognize revenue over 3 years?
No. So the entire payment is recorded when the grant is awarded, typically on the date of a signed grant agreement or award letter. Note, this is different than our conditional grant example, where you had to spend the money before recognizing the income.
Okay, I think I get it.
And one other thing to note in your example is that time restrictions can be implied or explicit. So in your example, Miranda, the time restriction is implied because the grant is payable over 3 years.
So this is complicated. So even though the grant is unrestricted for its purpose, I would still have to recognize the last 2 installments as time restricted.
That's correct. All right, I see we're getting a lot of questions, so let me see if we can answer some of those. So one of our viewers asks, if someone is given a grant that requires matching, if you don't find the match, they can pull the original grant money. So yes, because the condition of you getting the money is making the match. But if you feel like there's an opportunity to negotiate with your funder to maybe get more time for the match, I definitely recommend talking to your funder so that you can have enough time to get to the match so they don't pull those funds from you.
Somebody asked about timing of recognition of funds. So recognition is just when you call it income. You could get money today and it's not income to you yet. You have to do something before you can call it income. Or you could get a letter today saying you're going to get money later, but it's income now. So revenue recognition, of course, in accounting doesn't always match when you get the money. It's when you have the right to have that money, whenever you never have to return it.
Yep. Another person asks, is a matching grant cost reimbursable? So that would be determined by the grant agreement. Generally speaking, what I've seen is if you have a matching grant, it's usually once you match the amount of money you need to match, you get the funding. It's not, you have to incur qualifying expenses. But if your grantor set up your grant agreement that way, then it could be cost reimbursable.
And somebody asked about having to cover employee costs and alumni assistance with college fees on a grant. That's probably restricted, right? It's probably restricted and you recognize it today, but match expenses over time. But again, these are very nuanced. You have to read your grant agreement to figure out if there are conditions in there where you might have to give it back.
Yep. And yes, question, imposed timing is a restriction, not a condition. That's correct. You're on the right track. All right. I know we have a lot more questions. We'll move and we'll try to get to all of them as we move forward. Some of them will be answered in future slides. So let's take a look at an example here. So Miranda, when you look at this snippet from a grant agreement, do you think this grant has any restrictions?
Well, I see that the grant has to be used to support the approved enrollment growth of the charter school. So yes, I think that's a restriction.
Correct. So it is donor restricted in this case because the grantor specifies that the grant funds are to be used only for growing the charter school's enrollment.
So when would I recognize this $300,000 as revenue?
That is a great question. So in this case, you would recognize it as restricted revenue when you sign the grant agreement.
I've also seen in grants, sometimes it says that you have to return unspent funds or submit a report at the end of the grant period. Are those conditions?
No. So a grantor requesting the return of any unspent funds is a typical request, especially with foundation grants. Additionally, requiring a closeout report would generally not be construed as a donor-imposed condition because it's not related to the purpose of the underlying agreement. So let's take a look at another example. So Miranda, what do you think about this grant? Are there any conditions or restrictions?
Okay, it does say it must be used exclusively for a specific purpose, so that looks like a restriction. There are milestones that are mentioned with the payments, so that seems conditional, but maybe only the second and third part are conditional. I don't know, Ben, is part of this grant conditional?
We are on the right track. So 200,000 is conditioned upon the formation of the Alumni Council, and 200,000 is conditioned upon meeting the program delivery milestones. So these two amounts are conditional because the grantee must meet these requirements before they're entitled to receive or keep the grant funds. But notice that there is no barrier tied to the receipt of the initial 100,000.
So I recognize the 100,000 when I signed the grant agreement, but is it restricted?
It is for the purpose outlined in the agreement. But as you said, you would recognize the revenue, i.e. record it in your books once you have a signed agreement.
So this grant is both conditional and restricted.
Exactly. That's why reviewing the entire agreement is so critical. This is why sometimes a grant can be so overly limiting that it's not even worth accepting, which can be a tough pill to swallow for nonprofit management. So let's just take a moment now to pause and reflect. We've just walked through some examples of restricted and conditional grants. If your head is spinning, you're not alone. Grant agreements can be incredibly nuanced. Sometimes what looks simple on the surface hides a lot of complexity underneath. Our goal in this session is to take a very complicated and sometimes ambiguous process and make it feel straightforward. But remember, every grant is different, and the accounting can get tricky. That's why it's so important to understand the details, and when in doubt, seek expert guidance. As we move forward, keep in mind that we're here to help you navigate these challenges and make the process as clear as possible. Okay, well, now that we all understand the basics, let's do our second poll question. Which of the following might represent a donor-imposed condition that would delay revenue recognition? So Miranda, while they're answering the question, what are some conditions that you've seen in grants?
Matching is very common, right? You have to go raise some more funds. Sometimes a condition might say you're going to increase your services by a specific percentage. Sometimes you say in a grant that you're going to serve a number of students or a number of clients or a number of pets, right? Those, whenever you put those hard numbers in there as milestones, that becomes a condition. Sometimes you say you're going to hire somebody who doesn't currently work there. So until you hire that person, that would be a condition. Ultimately, when you're writing grant proposals, try not to add conditions that you're going to have to meet in order to keep the grantor's money.
That's a great tip, Miranda. You want to make sure you're not the one setting the conditions on the use of the money. Just let the grantor set the conditions and don't give them any ideas.
Right.
All right. Looks like our poll is coming in well. Let's see if there's any other. Wow, there's a lot of questions. Oh, so a question on our example on the $500,000 grant, you recognize 100,000 and then the remainder is deferred revenue. So I think that's on our conditional grant example where we had 100,000 sign of the agreement, that would be restricted at that time. The other two pieces are not revenue until you've met the condition.
A couple questions on cost reimbursement grants. Those are conditional. They're conditional on incurring expenses. So usually, on a monthly basis, you would record the revenue that would offset those expenses that you incurred. Keep that in mind if you don't do monthly billing too. That's still revenue for that month.
All right, let's see our results. So
yes.
The donor imposed condition, yes, the requirement to serve 100 meals per week.
Mm-hmm. And that grant payable over 3 years, that is just timing restricted. If it's restricted or whatever, you would just call it a receivable today, and it would be timing restricted as it comes in over the next 3 years. Okay, let's change gears a bit. Now we're going to talk about the grant life cycle. So there's 3 parts to the grant life cycle. For the pre-award, that's when you find the grant and you develop a proposal. The award period, that's when you review and accept the award and you document the intake form for the award and you implement whatever initiative you're supposed to be doing. And then finally, post-award, that's the reporting, the closeout, and the audit. So let's start with talking about the pre-award stage of the grant life cycle. So here's a sampling of ways actually to identify grant opportunities. First, we have the federal government. The federal government routinely posts funding opportunities to the grants.gov site. At any one time, there could be between 1,500 to 2,000 grants available. Be sure to check out YPTC's website for recent webinars where we've talked about different ways to find federal awards.
Next are state and local governments. Don't underestimate the hidden resources that can be found by exploring state and local websites and state nonprofit associations. On state websites, use search terms like grants or funding opportunities. Keep in mind that some states require charitable registration in order to be eligible to apply for a state grant. State associations might also provide links to state-specific grant databases and even member discounts on database platforms like GrantStation.
Corporations, CSR programs, that's short for corporate social responsibility programs. Those are initiatives that companies create to give back to society. These programs often include grants, sponsorships, employee matching programs, volunteerism, and in-kind donations that support nonprofits and community causes. Search company websites that have sections like community, social impact, or CSR programs. Google, Walmart, Target, and Bank of America are all examples of companies that have CSR programs. You can use tools like Double the Donation or Charity Navigator to identify corporate donors.
In our last grantor type, the foundations. Many foundations prefer to fund organizations they know and trust. Be sure to attend foundation-hosted webinars or events and make connections through your board members. Tip, reviewing a foundation's Form 990-PF might help you understand a foundation's funding priorities, see initiatives they've funded recently, and identify average grant sizes. Tools like GrantMakers.io make Form 990 data searchable and free. Foundation Directory Online, FDO, is a comprehensive grant research tool developed by Candid, formerly the Foundation Center. It's one of the most widely used databases for nonprofits seeking funding from foundations, corporations, and even grant-making public charities.
And speaking of free, did you know many public libraries offer free access to grant research tools such as the Foundation Directory Online, GrantMakers.io, and Philanthropy News Digest? Here's an example, the California Grants Portal. This is a project by the California State Library. It boasts an incredibly simple and clear grant searching database. Check it out. The first way to find grants is to determine what type of grant application your organization is targeting. Are you looking for a grant to support a current program? These are generally easier to fit into your current budget, but they're harder to secure ongoing funding for, since donors generally want to finance new initiatives. This is why you need to build strong relationships with your current funders. Or are you looking for a grant to support a new program? So the important thing to think about here is that, sometimes nonprofits get starstruck by the idea of a new multi-million-dollar grant, not thinking that once that funding runs out, they might not have the capacity to continue the new activity or program they created. We've seen entities hire folks to implement a brand new program and then have to let them go in 3 years when their funding has run out. Don't let that happen to you. Think carefully about how the new program or activity fits into your entity's current priorities and mission, and what might be needed to maintain the new initiative in the long term.
The next step in the pre-award process is proposal development. This includes organizational, financial, program info, and other. Successful proposals require finance, program, and development staff to work together to assemble supporting documents. Something that we cannot stress enough, always, always, always read the eligibility criteria first. And just a couple of definitions from this slide. When we use the term SMART, we're talking about specific, measurable, achievable, relevant, time-bound goals. And I did see a question in the chat about what to do if a grant asks you to create SMART goals, but you also don't want to put conditions. What I would say there is just make sure when you're being specific and measurable, you're not somehow putting you to a situation where you have to meet your SMART goal before the funder will give you the money. So you want to make sure your SMART goal is not saying you are going to do this, rather this is our aspiration of what we're going to achieve if we receive the grant funds from you. The other definition, UEI, Unique Entity ID, this is required in order to do business with the federal government. They are created in sam.gov, which is the system for award management the federal government uses, and it replaces DUNS.
Funders prefer to fund projects with multiple sources of support. They want assurance that their investment is part of a broader network of support. It reduces their risk and signals that your project has wide appeal and sustainability. Funders are looking for evidence of other committed or potential funding sources, partnerships with other organizations or matching funds, in-kind contributions like donated services, volunteer time. So in this budget example, the nonprofit might mention that they have secured a marketing firm willing to contribute a portion of the publication costs as an in-kind contribution.
So how can we demonstrate to funders that we have support from others for our project?
What we're showing on this slide is an example of that. So it's showing the funding request for this grant, but also the full project budget and what's going to be covered by other funding sources. So include a section in your proposal listing both confirmed and pending funding sources. Highlight any cost sharing arrangements or collaborative partnerships. And for large awards, you may get asked to present a realistic plan for financial sustainability beyond the grant period.
What are some of the common mistakes you've seen nonprofits make when submitting their funding request or budget?
You shouldn't submit a budget that relies entirely on one funder. Failing to mention other sources of support, even if they're small or in kind, is likely to get you denied. When we talk about grant budgets, many nonprofits focus only on their direct costs, things like program staff, materials, and activities, but indirect costs are just as important. So what are indirect costs? Indirect costs cover the overhead that keeps your organization. That's things like rent, utilities, administrative support. They're not tied to one specific project, but without them, you can't deliver your program. And why should you include them? Funders often allow reasonable indirect cost rates in your grant budget. Including them in the budget shows that you understand the true cost of delivering your program and helps prevent strain on your unrestricted funds. And how do you include them? First, check the funder's guidelines for allowable rates. Clearly separate direct and indirect costs in your budget. And if the funder doesn't specify, justify the rate that you're using based on actual overhead expenses.
Now, Miranda, I see a question in the chat. It says, if an organization is new to grants, how can the additional costs be planned or budgeted for the non-programmatic costs, i.e. indirect overheads?
You might have to translate that for me.
So I think what I'm hearing on the question is, what should the organization do if they're new to grants to be able to separate their direct costs from their indirect costs when they're putting together proposals for grants?
Okay, got it. So indirect costs, think about the things that are benefiting your entire organization. And it's kind of hard to figure out exactly how much office rent expense is being used. But you could also look at, hey, who's in my program and where are they sitting? Do they take up about a quarter of this office, right? And you could put about that much of your rent, you know, and say that that might be your overhead related to rent. And the same with utilities. Time and effort is a really common way that people might figure out their overhead and how much is being used for each program. You know, figuring out how much of their staff is working on each different program. And of course, remember, indirect costs also would impact things like fundraising and general and administrative departments as well. Okay, Ben, let's play a little family feud. If we were to poll funders and say, why are grant applications denied? What would they say? The answers are on the board.
Well, I think number 5 is probably going to be weak narrative.
Right. A proposal that doesn't clearly explain your need and the impact you intend to have will fall flat.
Coming in at number 4, probably unrealistic or incomplete budget.
Yes, budgets that are unrealistic, incomplete, or don't match your narrative will raise red flags. So will asking for more money than seems reasonable for your project.
Lucky number 3 has to be the proposal lacks specific and or measurable goals.
Right. Funders want you to have goals that are specific, measurable, achievable, relevant, and time-bound, SMART goals.
Number 2, maybe that would be like misalignment with the grantor's priorities.
You're so good at this. Funders want to see a clear connection between their objectives and the applicant's work.
And the number 1 reason, drum roll please, has to be failure to follow instructions.
Ignoring formatting guidelines, missing attachments, or submitting late can lead to automatic rejection.
All right, a couple more questions came in on the indirect cost question. Can indirect costs be a percentage or specific expenses that weren't included in the budget?
They can be specific expenses, and they are a percentage. Most most grantors have a rate that they won't let you exceed. The federal government, for example, uses 10% or 15% as their de minimis. But there, you can also try to justify your overhead rate based on real expenses that you have, and sometimes grantors will allow for more than a de minimis amount. But it should be mentioned in their guidelines in the grant applications. Yes,
and that answers another question someone asked: is 10% fairly common? And yes, it is, because that used to be the de minimis rate for federal grants. It's now been increased to 15%.
And yes, indirect costs are auditable. Yes, they will audit those.
All right, so congratulations. You've been notified your organization has received the grant. Now what? Here are some details your team will need to understand before getting to work. We've broken it down into 3 different categories: compliance, financial, and communication. Let's start with compliance. The terms. Make sure you read the grant agreement carefully to understand all the terms, conditions, and specific rules for how the funds can be spent. An important tip: be sure to send the signed agreement back within the funder's requested timeline. You would be surprised how often we've seen this, and it usually happens during transitions. Next is the reporting. Be aware of the grantor's reporting expectations, including frequency and the type of data needed. Some grants require detailed monthly or quarterly reports, which can be a significant administrative burden. Lastly, audits, everybody's least favorite. Accepting a grant may trigger new or more extensive audit requirements. For example, federal award expenditures over a certain threshold in a single year often require a special single audit. Next, let's look at the financial. First, and super important, is cash flow. You need to understand how and when you will receive the funds. Tip, many grants operate on a reimbursement basis, meaning you'll need to cover upfront costs before getting paid. So you need to ensure your organization has the cash flow to manage this. Next, overhead costs. Grant funds don't always cover all the administrative overhead costs associated with the project. Be sure your team understands what is or isn't an allowable cost for the grant. When dealing with a federal award, you may need to negotiate for an indirect cost rate agreement. For more on negotiating indirect costs, be sure to check out YPTC's April national webinar. If your grant has matching funds, make sure that you understand what you need to do to make that match happen for your organization. Verify you have internal resources or other committed funding to meet this requirement. Most importantly, ask who among your team is monitoring that the matching funds are received. In financial management, you'll need a financial management system to track and document all income and expenses. Later in this presentation, we'll share some key grant accounting practices. And then the last column is all about communication. First, capacity. Evaluate your organization's capacity to take on the new project. Will you need to hire new staff? Will you need existing staff to take on new duties or participate in funder-specific training? Consider the training and the time needed. Communication with the grantor. Establish clear communication channels with the grantor. Confirm their preferred method and frequency for updates. We cannot stress this enough. And lastly, many grants require public acknowledgement through press releases or social media. Be sure to follow the funder's specific guidelines regarding logos and messaging. And finally, don't forget to craft that thank you letter to the funder.
This is a sample grant intake form. So it shows basic grant information, the amount, the period, the award date, the payment schedule, a lot of the basics that you need to know and document for your grants.
So Miranda, where does this intake form come from?
You need to make it. Your organization needs to create a way for you to summarize your grant award and share it with your entire team. Rarely does the grantor provide this in such a neat package, but the information comes from your grant award letter or contracts. Here's the second page of it. So here we have contact information, the revenue recognition details, and the reporting deadlines. So the accounting information here is something that your accountant or someone with a solid understanding of the applicable accounting guidance is going to have to determine, ideally after reviewing the full agreement. I've had funders tell clients in their award letters how to recognize the revenue, but it's not common. Usually you have to read it and make sense of what they've written. And, I did have a client whose major funder always told them how to recognize their revenue, and they still messed it up. So we had to do an adjustment of $1 million to help them fix it. That's why you need all of this information on a grant intake form, so you can be sure you're tracking things correctly with your grants. And possibly the two most important pieces of information is that financial reporting schedule and the grantor's contact information. Again, you need to build a relationship with your grants officer or whoever your identified contact is. Now let's talk about reporting. Here are some tips. Submitting reports on time is critical. Late reports can jeopardize future funding. Build internal reminders well before the deadlines. Always use the reporting template or format provided by the funder. This ensures compliance and makes their review process easier. Explain any variances honestly. Funders appreciate transparency, and many allow variances within a certain percentage. And remember, not all funders want the same thing from you. Some want you to report only the amount they funded. Others require reporting on the entire project budget, including contributions from other sources. Clarify their expectations early so you don't miss any key details. Again, this is why building strong relationships with funders is so important.
Now let's talk about the closing out of the grant. You want to use your checklist as a template for every grant award to create consistency and help your organization stay audit ready. Again, we've broken it down into 3 categories: compliance, financial, and project management. On the compliance side, start by confirming all grant conditions have been met. This includes any special requirements from the funder. Make sure you maintain centralized documentation so everything is easy to access for audits or future reference. Document any matched costs or in-kind donations. These are often required for reporting. Address equipment disposition requirements. Some grants require you to report or transfer ownership of that equipment. And finally, verify that all the expenditures are allowable and reasonable under grant terms. In the financial bucket, you want to reconcile your final financial report with your accounting records to avoid surprises later. This also keeps you audit ready. You want to make sure your payroll department knows to end any payroll allocations tied to the grant and confirm that you've received all payments. Reach out to your grants officer for updates. On the project management side, make sure you submit all your final reports to the funder. These often include both narrative and financial components. You want to document the outcomes and deliverables achieved. This helps demonstrate your impact. Collect feedback from stakeholders and beneficiaries for evaluation and future improvement. Many funders will ask for this. And lastly, notify internal departments about the grant closeout and archive all your grant files securely. So for anyone keeping count, this is our 3rd poll question. What's the biggest challenge your organization faces when applying for grants? And this is our poll question that doesn't have a right answer. So select the one that applies to you. So this is a great time to mention that YPTC has a ton of free resources on our website at yptc.com.
Yes, and of course, we offer grant management and budgeting services in addition to doing accounting for our clients. We can help you through the audit process, including single audits and anything else that comes up with your grants. Ben, you mentioned single audits a minute ago. Do you want to talk about those for just a second?
Sure, I'll add a little more detail there. So single audit is a test of controls, compliance with uniform guidance for the federal awards that you received, and it's triggered by total expenditures in your fiscal year. So for fiscal years beginning before October 1st, 2024, the threshold was $750,000. After October 1st, 2024, it was raised to $1 million.
And YPTC has an entire department dedicated to helping our clients with federal awards in managing them, ensuring compliance, and finding and applying for grants. So if you're interested in that, also check out our website.
All right, let's see what biggest challenge. Finding funders that align with our mission and budgeting.
Wow.
Yes.
Well, let's actually move on to our final section. And I think this one's going to help some of you guys' questions also. So how can we set up our accounting system for better grants management? Answer, start with a good foundation and utilize time-saving features within your accounting software. Every accounting software has the capability to track transactions using different dimensions beyond the basic accounts. In QuickBooks Online, for example, you can set up dimensions for things like classes, locations, projects, tags, etc. If you use the appropriate dimensions, it can really help you track your grants effectively and make reporting so much easier. And every accounting software has a version of these dimensions, many far more robust than QuickBooks Online. I'm just using QBO as an example because it's inexpensive, and most organizations start out using it. In fact, 75% of YPTC's clients use QBO. But like it says, we need to start with that good foundation. So what is the foundation? It's your chart of accounts. Here are 2 different methods. one better than the other, that organizations might use to design their chart of accounts. You can see one of these lists is a lot longer than the other and uses detailed names and descriptions for each account, while the other uses more high-level account names that will exist on an ongoing basis within the organization. For example, on the do this side, donations are grouped together, while on the right side, it has them broken out by various program or grant types. YBTC does have a training on this. It should be in your resources widget. But essentially, the accounts that you use in your chart of accounts should be standard for your sector, accounts that your organization is going to need year after year. Okay, so here's our tip. Don't create a new account every time you get a new program or grant. Not only are you going to drive your accountant crazy and make your chart of accounts really long, it's also going to be very difficult to compile the information you need for grant reporting. You do need to know the program and grant level detail of transactions, and you do need to be able to run reports for those, but the chart of accounts is not the place to do that. Again, this example was created in QBO, but you can do this in other software packages, using account segments and some strategic account numbering. Bottom line, it's always smart to ask a skilled accountant to help you set up your chart of accounts. So you may be asking, how do I track spending on my accounts? Well, let's look at some other account settings that you should be using. So again, this is QuickBooks Online. I would suggest using the classes feature. You can toggle on the track classes feature within your QuickBooks Online company settings from the advanced menu. Then use this to create classes for your functional activities. These are going to be things like fundraising, general and administrative, and program, your header classes. If your nonprofit has membership, add a class for that. Within each header class, create subclasses for your major programs and activities. So again, instead of creating an account for every program or function that you have, use a class for those. Your chart of accounts will stay clean, and it's very easy to run combined or class level reports. So here under extracurricular activities, we have athletics, clubs, and field trips. You just make those subclasses. Also, and here's something someone asked about, to be allocated. That's where you're going to capture those expenses that you're going to allocate later amongst the different functions. But do you notice this is not where we're tracking funders or grantors? You don't need classes for funders or names of grants. I'm going to show you how to do that next. So here's the next dimension. This is how you can break out funder level details. So if you're following me, we now have account level tracking through our chart of accounts, program and function level tracking through our classes, and the next setting is using customers in QBO. One more dimension. We can use the customer dimension to track activity by funder. And this setting lets you track both the receipts that are coming in and your spending, your expenses related to the grant. In your account settings from the expenditure menu, toggle on the track expenditures by and items by customer setting. This will allow you to run a report showing the revenue and related expenses by each funding source. If a grantor provides funds for multiple projects, no problem. You can use classes to track the various projects or set up another dimension, a project within QBO. So let's pull it all together by showing you how we would use those customer and class to enter a bill. In this screenshot from QuickBooks Online, we're entering a new bill and we want the expenditure to be charged against a specific foundation grant. So you're going to select the foundation's name. This is an expense, remember, but so over there in the customer, what's the grant name? That's where you pick it. And then assign the proper class or activity. So in this example, the class is support services program. You can assign multiple customers and classes to a single bill. You just need to input each on a different line. And here's our quiz and our fourth poll question. Which feature in QuickBooks Online will help track expenses by funder? I don't know. I mentioned all of these, I think, casually. Let's see what you guys come up with.
So why do so many nonprofits start out using QBO?
Well, QuickBooks Online is cloud-based. It's easy to learn. Most bookkeepers and accountants are familiar with it, and it's inexpensive. So really, that's why most organizations start out using it. Do you think our audience knows about TechSoup, Ben?
Well, if they don't, it is a nonprofit that provides tech resources to other nonprofits at a discounted rate. And QBO is one of the many software applications they have on their website for nonprofits to purchase.
Right. We don't get a kickback from them, but last time I checked, you can get QBO Advanced from TechSoup for less than $200 a year. It's a really good deal.
All right. Let's see how we've got.
Customers. Some people got tricked. Classes, we want to use those for our programs and functions, but our funders will use customers. So here's where it's all going to come together for your reporting. So by using the QuickBooks Online features that we just covered, the result is the ability to run reports easily in your accounting system by class as well as by funder. Here's an example. This is a statement of activity by grant. It's just a filtered report, statement of activity by customer from QBO. Because we've tracked both our revenue in and our expenses against each individual restricted grant, we can instantly see there are 4 grants for which we have funds remaining. QuickBooks Online, like we said, is a great starting point for nonprofits managing basic finances and a smaller number of grants. As your organization grows, so does the complexity of your grant portfolio, and QuickBooks alone might not always be enough. Here's a few signs that you've outgrown QuickBooks Online for tracking. If you're manually tracking grant deadlines, reporting requirements, and renewal dates in spreadsheets, if your team struggles to collaborate on grant tasks or shares updates in real time, if you need to report on restricted versus unrestricted funds across multiple grants and programs, if funders are requesting detailed outcome reports that are hard to generate from QBO. Now, we talked a lot about things that you should do first. Start using all those dimensions in QuickBooks Online. Make sure you have a grant intake form. Do all the things first, but eventually, you can outgrow QuickBooks Online.
So here are some typical features to look for when evaluating grant management software solutions. You want features that are centralized, collaborative, and automated. So just a couple of features to call out that are listed on this slide. Search tools, for example. Some solutions offer AI-powered search tools that match your nonprofit's mission with relevant funding opportunities, which could save your team a lot of time. There are some that have proposal development tools that might include things like templates to help draft compelling proposals or collaboration features for team input and editing. And lastly, look for integration capabilities. Some solutions might sync with your CRM and with QBO, or if you're not using QBO, your other accounting system. And this is ideal for organizations with both development and finance staff. And that brings us to the end of our presentation today. So we talked about a number of different grant types, the grant lifecycle, and some grant accounting best practices. These are a few of the takeaways that we've compiled for you. And I know we have a lot of questions with very little time. So let's see what we can get off of the question list.
Sure.
All right.
You start at the top, I'll start at the bottom.
Okay. Is there any advantage of using a true fund accounting system, i.e. a PLOSA, broadband, MIP, etc.? So there may be advantages to that. It depends on your organization, obviously. In some cases, QBO can handle what you're looking for, but in other cases, it may not. So you might want to look at a different accounting system that is a true fund system, such as MIP, or there's Sage Intacct, NetSuite. There's a host of other software applications. Oh, this is a great question that I hear all the time. What, if any, CRM tools integrate with QBO? I would say, in my experience, there's not a CRM tool that integrates perfectly with QBO, but some of them get part of the way or enough of the way there that it does help save you time. So I've seen integrations with like Donor Perfect, with Little Green Light, to name a few. but I don't want to set your expectation that there's one out there that perfectly integrates with QBO. It just doesn't exist yet, but we're hopeful in the future that it will.
Someone's asking about which one would be more important for restriction, time or purpose. You can have things that are both time and purpose restricted. A good example would be a pledge for like a capital campaign, right? That is not a grant, but it's still an example of something that you're going to receive over multiple years, and it's still restricted. So if you guys have ever read that portion of like on your financials, your audited financials, right, you would have the restriction type. That example would be both time and purpose restricted.
All right, looks like we're at time, and I know we didn't get to very many of the questions. So hopefully, I don't know what happens if we're able to grab the questions and maybe answer them later in some type of format, but we appreciate all of you joining us today for this webinar and for all of your questions. If you have more questions for us or would like to talk to us, you can contact us at the information on the slide.
And again, check out our website. We have so many resources. We do these webinars, pretty much every month. You can follow us on LinkedIn, all the things. We're always happy to talk nonprofit nerdiness with all of you.